everyone, welcome back to EduTap and welcome to Finance Current Affairs session. In today's session, we are going to start with a very important report that is released by the Reserve Bank of India, that is the Financial Stability Report. So we all know that how important the FSR is from the exam's perspective, and the data points can be directly asked in the examination, as well as you need to have the complete analysis for the FSR. So in today's session, let's start with the understanding of the FSR and the analysis of the Financial Stability Report, as well as the data points of the FSR. Today we are going to start with the data points from the FSR, and the most important newspapers have also covered the data points from the FSR. So let's see all of those data points that is important in the FSR. So today let's have the starting of the complete analysis of the FSR. But before starting with this, there is a big announcement from EduTap that we have brought for you the complete guidebook for RBI, NABARD and SEBI. So through a single guidebook, you can get all your common queries answered. If you want to know about the examination, what is the previous year cutoff of the examination, what is the pattern of the examination, what is the syllabus for the examination, all those queries can be answered through a single guidebook, and there are the definitive answers that is provided in this guidebook. Even if you want to know about the preparation for the examination, what should be the sources for the preparation, what should be the strategy for the preparation, all those queries can be answered through this guidebook. You do not have to visit different links, you do not have to visit different websites, and this guidebook is absolutely free of cost to save your time and to save your effort, and you can easily download this guidebook. The link is provided in the description box below, so do download this guidebook. The link is given in the description box below. Okay, so now coming to the Financial Stability Report that is released by the Reserve Bank of India in December 2022. So the previous publication of the FSR was in June 2022. So we can understand that this report is released twice in a year. Okay, so this is a semi-annual publication. Okay, so now coming to who releases it. So the RBI is releasing it, but who is making it? Okay, so on what basis is this report made? So first of all, the FSDC, that is the Financial Stability and Development Council, has a subcommittee. That is subcommittee of FSDC. Now the FSDC is chaired by the Finance Minister. FSDC is chaired by the Finance Minister, and the members of FSDC are the head of the financial sector regulators, like the head of the Reserve Bank of India, the head of the SEBI, the head of RBI, the head of PFRDA, as well as the Chief Economic Advisor, the Finance Secretary. So such heads are the members of the Financial Stability and Development Council. Now coming to the subcommittee, who is chairing this subcommittee? So the Governor of the Reserve Bank of India is chairing this subcommittee. So the subcommittee of FSDC is chaired by the Governor of the RBI, and all the members of the FSDC are also the members of the subcommittee of FSDC, that is the head of the SEBI, the head of RBI, PFRDA, as well as the economic advisor, the chief economic advisor, the finance secretary. Those are also the members of subcommittee of FSDC. So the members of FSDC are the members of the subcommittee of FSDC also. So now this subcommittee of the FSDC is the one that do the collective assessment, and that brings out this report, we can say. So the Reserve Bank has released this 26th issue of the FSR. So this FSR is the 26th issue of the FSR, which reflects the collective assessment of the subcommittee of the FSDC on risk to financial stability. So we have understood that this report is the collective assessment that is done by the subcommittee of the FSDC, and on what assessment is happening. So the assessment is happening on the risk to the financial stability and the resilience of the financial system. That what are the risks that is coming for the financial system, and how resilient our financial system is. So this is the report that is released by the RBI, that is the collective assessment of the subcommittee of FSDC. So what we have understood is that the FSR is a semi-annual publication with inputs from all the financial sector regulators. So here you can see that the subcommittee of FSDC is chaired by the Governor of RBI, and the members of this subcommittee are the regulators, financial sector regulators, the head of the financial sector regulators. So it reflects the overall evaluation of the subcommittee of the FSDC. So in this report, we will study the evaluation that is done by from the inputs from all the financial sector regulators. So this FSR report is divided into 3 chapters. The first chapter is regarding the risk. the macro financial risk. So what is the meaning of macro financial risk? That is the complete financial system. What risks are coming to this financial system? Macro means that we are seeing it completely. We are seeing the financial system in a whole way, in a complete way. Okay. So macro financial risk, first we will see that what risks are coming to the financial system. Then the second chapter is regarding the financial institutions, soundness and resilience. So what the financial system institutions are. So the banks are there, okay, scheduled commercial bank, the cooperative banks, the NBFCs are there. So financial institutions, how sound they are, how resilient they are against these risks. So then we will see that. The third chapter is the regulatory initiatives in the financial sector. So the Reserve Bank of India has taken much initiatives in the financial sector. So we will see the regulatory initiatives that is taken in the financial sector. So these are the three chapters that you have to remember. So starting with the first chapter, that is macro financial risk in the global level. What are the risks in the global level to the financial system? So we have seen that in the global economy there is many troubles that are coming together. Okay, a formidable headwind, multiple shock that is happening, and that has led to the tightening of financial conditions. So what has happened? First of all, that COVID was there. Then came the Russia-Ukraine war. Due to these, there is much volatility that has come in the financial market. So the financial conditions has tightened because due to the Russia-Ukraine war, the inflation was there. Due to the Russia-Ukraine war, there was inflation that was coming. To control this inflation, the Reserve Bank of India, what it did, it increased the repo rate. Similarly, the other countries, the financial regulators or the monetary authority, what they were doing, the central banks of other countries, they were also increasing the interest rate. Due to this, there was the tightening of financial conditions. Okay, because when the interest rate is increased, that means the money supply is sucked up. The interest rate is increasing in many of the countries. So the capital outflows are happening. Capital is going to the countries that has higher and higher interest rate. So there is much volatility that is coming in the financial market, in the financial sector. So the interaction of multiple shocks has resulted in the tightening of financial condition. The shock of the COVID, the shock of the supply chain disruption, the shock of the Russia-Ukraine war. This led to the tightening of financial conditions and heightened volatility in the financial markets. So we have seen that the global economy is faced with multiple shocks. Now, since the June 2022, the global economic outlook has been given and it has been deteriorated, we can say. So since the June 2022 issue, the last issue that has happened of the financial stability report, the global economic outlook has deteriorated further. Okay, there are much risk that are happening and hawkish stance. The hawkish stance are taken by the global regulators, the central banks of the different countries. So hawkish stance means that they are increasing their interest rate to control the inflation. Okay. So international organizations like the International Monetary Fund, the World Bank, the OECD, they all have downgraded, they all have decreased their projection, their forecast for the global growth. So here you can see that all the major institutions, the IMF estimates, the World Bank estimates, the OECD estimates, they all have decreased in a way. So for the OECD, you can see that the global, they estimated in June that the global growth will happen around 2.8% in 2023. But they decreased this global estimate to 2.2%. So that is 2.8 was low enough, but they have further decreased it to 2.2%. And they are saying that it can further go down. So you can understand that how low they are thinking about the projection, how low they are projecting the global growth. Okay. As well as the IMF has also decreased the projection for the growth in 2023 and 2022. Now we have seen of the global economy. Coming to the domestic Indian economy, what is happening that the Indian economy is also confronting. Of course, if the global economy includes the Indian economy also. So the Indian economy is confronting strong global headwinds. So the problem of Russia-Ukraine war, the problem of COVID, this was suffered by the Indian economy also. Okay. So yet the sound macroeconomic fundamentals, our fundamentals are very strong. Okay, we have sound good macroeconomic fundamentals. That is, the asset quality is improved, the profitability is going good, the capital buffers we are keeping good. So the fundamentals we are having quite sound. Healthy financial and non-financial sector balance sheets. So we are maintaining quite healthy balance sheets. and providing strength. They are the ones that are providing the strength. So good fundamentals, like when you have good fundamentals of a subject, then only you can build higher understanding of that subject. Similarly, when there are the good fundamentals, this provide the strength through the financial system of the country, okay, as well as the good balance sheets, healthy balance sheets, they are providing the strength and resilience for the financial system stability. So now you can see that despite significant global spillovers that was happening due to the Russia-Ukraine war, due to the COVID, the asset quality, the profitability, the capital and liquidity buffers in the Indian banking system provided comfort to the Indian financial system, you can see. So here in the financial system, the demand is quite good for the bank credit. The interest rate is quite high, we can say. It is increasing continuously because the Reserve Bank of India is increasing the repo rate. But still the credit growth is also high, we can see. So that is the trust of the people. The consumer confidence is quite high, due to which the investment is happening a lot also. So for that, the demand for bank credit is high, and early signs of revival in the investment cycle we have also seen. So even though the economy, the global economy is facing a lot of trouble, still the consumer confidence in India is quite high. Due to that consumer confidence, due to the confidence of the people in the regulatory system, in the RBI, in the government, we can say that the demand is not decreasing to a lot, and due to that the demand for bank credit, the investment cycle is again starting. It is again going good. So benefiting from the improved asset quality, a return to profitability and resilient capital and liquidity buffers, we can say the investment cycle can go good. So here inflation though elevated. So we have seen that from January 2022 till October 2022, the inflation was above 6%. So we have the range. The Reserve Bank of India or the government has set the range of 2 to 6%. That the inflation should not go below 2% and should not go above 6%. So this is the range, and the inflation should remain around 4%. Okay. But the inflation was above 6% from January 2022 to October 2022 for 10 continuous months. Then in November 2022, we saw that the inflation came down from this 6% mark, and it was around 5.8%. Okay, so the inflation though elevated is retreating in response to front-loaded monetary policy actions. So the Reserve Bank of India was continuously increasing the repo rate. It was continuously trying to take the steps. It was taking the steps to control the inflation. It was decreasing the money supply in the economy, and due to that front-loaded direct steps of the monetary policy, the inflation is retreating, but still the inflation can go above, okay, due to the global headwinds. And supply side interventions also happened. The government was also taking steps to decrease the inflation. So for now, the inflation is retreating. We have seen in November 2022 that the inflation came down from this 6%. Okay. But still the trouble is there. The RBI has also said that it can go above again. But what is happening, that the Reserve Bank of India, that the government of India, they are taking quite steps, and the financial stability is maintained by them. Okay, the macroeconomic fundamentals are quite strong in the economic system, in the financial system of our country, and due to that the microfinancial risks are not posing a very big threat for us. Okay, so the financial system stability is still remained in the country. We are quite resilient. So what we have understood. Now coming to financial institutions soundness and resilience, that how we are resilient. Okay, so this chapter presents an evaluation of the soundness and resilience of financial intermediaries. We have understood that the foundation is good, but on what basis? What basis we are saying that the asset quality is good? What data is there? So today we will see the data here through this topic, through this chapter. So financial intermediaries are quite sound and resilient in India. We are going to analyze their recent performance on the key parameters. Okay, so the combination of the regulatory measures that is taken by the Reserve Bank of India, okay, to cushion the banks since the onset of the pandemic, since the COVID started, the Reserve Bank of India wanted to maintain a good foundation for the banks, for the financial system of our country. Okay, banks own efforts in augmenting their capital base. Okay, then the RBI said that we have to maintain a good foundation, and the banks themselves, they started to take the efforts. They started to take the efforts to maintain the good capital, first to have the good asset quality, because they were also afraid that what will happen if we go down. Okay, so that's why the RBI's, the regulatory measures as well as their own efforts, this led to a good foundation for the financial system. reducing non-performing loans appear to have fortified their balance sheets. So they were maintaining good capital buffers as well as they were trying to reduce their NPAs. They were trying to maintain the asset quality. Because for the banks, the loans are the asset for the banks, because on the loans the banks are getting the interest rate. Okay, so they have to maintain a good asset quality. That is, if they are giving the loans, that loans should come back. That is the asset quality that they have to maintain. So now coming to the scheduled commercial bank, we have seen that a good foundation is there. So let's see the data. Let's see the data for the scheduled commercial banks. So for the scheduled commercial banks, the credit growth year on year, which started picking up during the second half of the 2021 to 22, from October 2021 we can say to March 2022, sustained its momentum and gathered pace to touch a decadal high. You can see that it was 11-year high or 10-year high of 17.4% as on December 16, 2022. So the credit growth was a decadal high in the December 2022, a level last observed during 2011. So you can see that this data shows that the credit growth is happening very fast in our country, and it was decadal high, and this data was shown in the newspapers also. So you have to remember, you should remember this data. Okay, direct question can come from this. Aggregate deposits recorded some moderation. There was some decline in the deposits, aggregate deposits that were happening, growing at 9.4% as on December 16, 2022. CASA, that is the current account and savings account, growth moderated. It declined a little. So the credit account, the current account and savings account deposit growth was moderated. It was declining to a little. Whereas the term deposits, the fixed deposits we can say, those attracted a lot. There was a lot response that was coming in due to the rising interest rate. So the interest rate was rising, and with that what was happening, that the term deposits increased while the current account, saving account deposits decreased. So here you can see the deposit growth. So for the all scheduled commercial banks, this was a little declined. Okay, from here it went to here. So there was a slight decline in the deposit growth, and further in December it was 9.4%. While for the current account, savings account, you can see that there was a decline. Okay, here for the all SCBs you can see September 2022 that it was declining, and it has further declined, while the term deposits, they are increasing. They are increasing. From here you can see they are increasing. So remember this, that the current account and the savings account deposit growth is decreasing. It is moderating, decreasing a little, but it has moderated, while the term deposits, they are increasing. Okay, and this data you have to remember. Okay, now coming to GNPA, that is gross non-performing asset ratio of the scheduled commercial banks, continued to decline and stood at a 7-year low of 5%. So the gross NPA, gross non-performing asset, they were continuously declining, and they saw the 7-year low of 5% in September 2022. The net non-performing NPA, the net non-performing asset, that is NNPA, stood at a 10-year low of 1.3%. So you can see that how well our asset quality is doing. The asset quality is quite good. Okay, the gross non-performing asset are declining, the net non-performing asset are declining, and it saw a 10-year low and it saw a 7-year low. So you have to remember this data point also. 7-year low, 10-year low, that is a big thing to achieve. The capital to risk weighted asset ratio, that is the capital buffer that we are keeping against the loans or the risk that we are taking. Okay, so the capital buffer that the banks are keeping against the risk that it is taking, so that was also quite high. It was 16% for the scheduled commercial bank, and the common equity tier 1, that is the liquid assets that the bank are maintaining, or the more liquid kind of capital that the banks are maintaining for the distress situation, that was 13%. So you can understand that the capital buffers the banks are maintaining, scheduled commercial banks are maintaining, are quite good. They are very good, the capital buffers. The asset quality is also improving. The credit growth has improved. It is decadal high to 17.4%. So this is all showing that how strong our fundamentals are, how strong our foundation is. Next is provisioning coverage ratio. So provisioning coverage ratio means, PCR means, it is a proportion of provision held for GNPA to GNPA. That is how much provision you are keeping. Let's say it is the percentage is 71.5%, 71.5 out of 100. So if a GNPA is gross non-performing asset is 100 crores, let's say, that means we have the coverage for 71.5 crores. So you can understand that how high it is. If the GNPA is, if the gross non-performing asset is this, the banks already have enough provision, enough capital to handle that kind of loss that they are facing. So the provisioning coverage ratio has been increasing steadily since March 2021 to 71.5%. Okay, so here you can see the PCR provisioning coverage ratio. So it was increasing, and in September 2022 it was 71.5%. Okay, it was increasing since March 2021, then it was September 2021, it increased further in March 2022, and it increased further in September 2022. For the GNPA, the gross non-performing assets that are happening, we already have enough coverage, enough provisions for that GNPA. Okay. So the profit after tax of the SCBs, that is the profit that the scheduled commercial banks are gaining, it is also registering a growth. So the profits are also increasing of 40.7% in first quarter of the 2022-23. So here you can see that for the first quarter or till the September 2022, we can say that the scheduled commercial banks, they saw a growth of 40.7%, that is led by strong growth in net interest income. That is the interest income minus the interest expense. So how much interest they are getting on the loans that they are giving, interest on loans minus the interest that they are interest on loans that they are getting minus the interest on loan that they have to give, that is interest on the deposits. So the net interest income is how much they are getting from the interest on the loans, how much they have to give minus how much they have to give as an interest on the deposit. So net interest income is also very good. It is strong growth has been seen in net interest income and a reduction in provisions, that is net NPA is decreasing, so provisions are not very good. They are not very high. They have not to be maintained high. So the interest income minus interest expense is the net interest income. That is also very strong. You have seen that the profits are growing. 40.7% is a very high number. Okay. So this was all. Next is macro stress test. So we have seen that the NPAs, that is the asset quality, is maintained good. The capital buffers are maintained good. The profit is quite good also. Now coming to macro stress test. For credit risk reveal that SCBs are well capitalized. So macro stress test means these are the tests that attempt to assess the capital ratios, that how good the capital ratios are maintained by the banks, here the scheduled commercial banks, over a 1 year horizon. So this test started from September 2022 because the FSR is giving most of the data for September 2022. Now 1 year horizon means this is seen for the future till September 2023. So the test attempt to access the capital ratios that are over a 1 year horizon under a baseline. So we are trying to see that in 1 year how we are going to have the capital ratios. Do we are going to have good capital ratios or bad capital ratios? So under a baseline means in the normal situation, that is expected to happen in the future. So in the normal situation, what will be the capital ratios in the 1 year, in the future 1 year? In the adverse, in the bad kind of situation. So this is the hypothetical situation or the assumptions that are taken. That if the adverse scenario come, that is if the medium adverse scenario come or if a severe adverse scenario come, then how much capital ratios we are going to keep. So adverse scenarios are the assessments under hypothetical adverse economic conditions. So we are trying to assess the capital ratios over a 1 year horizon, over a period of 1 year. That in 1 year, how good our capital ratios or how bad our capital ratios are going to happen. So first we are seeing it for the baseline, that in the normal situation for the 1 year, what will happen. Then we are seeing that if the medium adverse economic conditions are there, that is the hypothetical situation that we are thinking. And what if a severe economic condition, if severe adverse economic conditions come, then how much capital ratios we will be able to keep in September 2023. So here the data is given, the system level capital to risk weighted asset ratio, that is the capital buffer, that is the capital ratio in September 2023 under baseline scenario, under medium scenario and under severe stress scenario. So the test has shown that under the baseline scenario we will have 14.9% of the CRAR with the banks, with the scheduled commercial banks. Under the medium stress scenario, under the medium adverse economic conditions, we will have 14% of the CRAR. Under the severe, the worst kind of stress, if it is coming, then the banks will have 13.1% of the CRAR. Now all these percentages, you can see it is above the 11.5% mark of the CRAR with the capital consumption buffer. So that is CRAR plus the capital consumption buffer should be 11.5%, that is according to the RBI. The bank should have minimum of this. So all of this data, even the severe stress condition shows that we are going to have above 11.5%. That is, the macro stress test for credit risk revealed that SCBs are well capitalized and all banks would be able to comply with the minimum capital requirement of 11.5% even under the adverse stress scenario. Even under the severe stress scenario, still we will have good capital buffer. So this is the macro stress test that is taken for the future, that in 1 year how we are going to handle the situation. In the baseline scenario, in the common scenario that is happening until now, so that is projected for the future also. In the medium adverse scenario and in the severe stress scenario, there are three categories that are taken. Okay. Now sectoral asset quality. So this was the data point that was shown in most of the newspapers. So this data becomes very important for us because direct question can come from here. So the SCB's asset quality continued to improve across most sectors. We have seen that the GNPA and the NNPA, they were quite low. The GNPA was 5% and the NNPA was 1.3%. Okay. So now we have seen that the asset quality is quite good. And it is improved across most sectors. It is improved across most sectors, and the improvement in the GNPA ratio in respect to the industrial sector also continued. So here you can see for the industry sector, the GNPA has decreased. The GNPA has decreased for the industry sector also. But if we see the sub-sectors of the industrial sector, there is quite high. The GNPA is decreasing. For the gems and jewelry, and for the construction, the GNPA is decreasing, but still it is at a elevated level. It is at a high level. So here we can see 16.7% of the GNPA and the 18.3% of the GNPA. So here the question can come that from the industry sector, which of the subsectors are having the elevated GNPA. So here you have to remember that the gems and jewelry and the construction subsectors are the ones under the industry sector that have the elevated level of the GNPA, though in all segments the GNPA is decreasing. Okay, other than food processing, the just what you have to remember that the gems and jewelry and the construction, they have the elevated levels of the GNPA. Okay, that's all that was given in the newspaper that you have to remember. Okay. The second thing was regarding the asset quality of the personal loan segment improved. Okay, the personal loan segment, the asset quality has improved there also because most of the loans that is given by the banks, they are coming back. Okay, during the first half of the 2022-23, especially for housing and vehicle loans, you can see how low they are. How low the housing loans and the vehicle auto loans, the GNPA is in these categories. So you have to remember that in the personal loan segment category, the lowest of the GNPA or the highest of the asset quality is happening in the housing loans and the vehicle loans. So this was also given in the newspaper that you have to remember. Next thing is regarding of large borrowers in the gross advances of SCBs, scheduled commercial banks has been on a declining path. So that is here the gross advances from the total advances, how much advances are given to the large borrowers. So that is declining. Okay, total advances to the large borrowers is a declining, though it is not declining by much, it is only declining by a little bit. Okay, and their share in total GNPA has come down to 62.2%. Here you can see that the gross, and from the gross NPAs, from the total non-performing assets, the large borrowers are doing 62.2% of the gross NPAs. So from the 100% of the gross NPAs, total NPAs that is happening in the country, 62% 2.2% is done by the large borrowers, and that is lower, okay, because before it was 75.6%, 2 years earlier it was 75.6%, now it is 62.2%. So that is a good amount. We can say that the large borrowers are doing less of the NPAs now, okay. The GNPA ratio of large borrowers continued to improve, that is, it has improved, it has come down. For all the scheduled commercial banks, the large borrowers, the GNPA ratio has come down to 6.4% in September 2022 from over 10% that was in March 2021. So what we have understood is that the loans given to the large borrowers has declined. From the total gross NPAs, the gross NPA that is done by the large borrowers is again declined, okay, it has declined, so that is a good thing. The GNPA ratio has also declined for the large borrowers, that it has come down to 6.4%. so you have to remember this data very carefully because it was given in the newspapers also. Next thing is RBI mentioned that the share of the top 100 large borrowers. Now we have seen large borrowers, but top 100 borrowers, how they are doing. So the total loan book of the scheduled commercial banks continued to rise. So they are giving share in SEBI's loan. So it is rising, we can say. From here it has gone to up here and stood at 17.4% in September 2022. So we can see that the large borrowers are taking more and more loans. So the loans are continued. They are taking the loans from the banks. So that means the investment is happening, because large borrowers are taking the loans means that they are taking it for the industries, for setting up some new industries or something. So the investment is continuing. As well as the asset quality of the top 100 borrowers also improved considerably as their share in scheduled commercial banks GNPA declined. So here you can see that the share in scheduled commercial banks total GNPAs has declined of the top 100 borrowers to 5.4%. Before it was 6.8%. So this is for the large borrowers and this is for the 100 large borrowers. From the top 100 borrowers that are taking the loans. So they are taking more loans. That means the credit growth is increasing as well as the investment is also increasing in a way. Second is quality. Asset quality is also improving because the 100 large borrowers, the GNPA has declined from March 2021. So this is the data that you have to remember. Next, other financial intermediaries. So the CRAR, the capital to risk weighted asset ratio of the urban cooperative banks is 16.1%. So this is even higher than the scheduled commercial banks. Okay, scheduled commercial banks are maintaining 16% of the CRAR in September 2022, while the UCBs has maintained 16.1% in September 2022. The NBFCs still higher CRAR, 27.4%, because the most risky are the NBFCs. So they have to even maintain the higher CRAR. The consolidated solvency ratio of the insurance sector remains above the minimum threshold limit of 150%. So the solvency ratio, the minimum solvency ratio that the insurance sector has to maintain is 150%. So the solvency ratio that is maintained by the insurance sector is above this 150% mark. That is, solvency ratio is what? Solvency ratio formula measures the insurance company's cash flow, that how much income or the cash flow they are getting upon the liabilities. That is in comparison to the amount it owes as total life cover. How much it is getting, how much it has to give. So it should be 150 upon 100. So if it is liable to give 100 rupees, then it has to maintain with itself, it should have the cash flow of at least 150. So the solvency ratio of the insurance company assesses the ability of the insurance to meet its obligation. Is it going to complete? Is it going to have enough for the liability, for the money that it has to give? Next is network analysis indicates that the total outstanding bilateral exposure. Network analysis means that how much network I have. I have the connection with one other person. So I am giving the loan to this person is giving me deposit. So the network is there. So network analysis indicates that the total outstanding bilateral exposure among constituents of the financial systems are stable. That means if a bank is giving the loan to the NBFC, or the NBFC is giving loan to this bank, so the bilateral exposure, loans that are happening, they are stable or not. Is this NBFC going to give back the money on time or not? So that is the network analysis that is done. So that is quite stable for Indian economy, for the financial intermediaries of our country. So the network analysis is quite good for our constituents of the financial system. They are stable. Simulated contagion analysis means if the losses are contagious or not. So simulated contagion analysis shows that losses due to failure of 5 banks with the maximum capacity to cause contagion would not lead to failure of any additional bank. So top 5 banks, if they are going into losses, if they are going down, so other banks will also go down. So the contagion analysis shows that it is not going to happen. If the top 5 banks are going down, then the other banks will not be affected. So that is what the contagion analysis is showing. So showing a simulated contagion analysis shows that the losses due to failure of 5 banks, 5 top banks with the maximum capacity, with the maximum network, with the maximum capacity, with the maximum deposits to cause contagion that is connected to most of the other banks. Top 5 banks that is also connected to most of the other banks, most of the other financial intermediaries would not lead to failure in India of any additional bank. So I hope you have understood this also very well. So SEBs continue to have the largest bilateral exposures in the Indian financial system, which reached pre-pandemic levels in September 2022. So this you have to also remember that after the network analysis, this was found that the scheduled commercial banks are the ones that have the largest bilateral exposure that are connected to the other financial institutions, and this is even above the pre-pandemic level that was in the September 2022. The data has shown that the SEBs has the largest bilateral exposure, okay, and still it is stable. The network analysis has shown that the connections are stable. There is no harm in that. So I hope you have understood the 2 chapters that we have completed today. So the 3rd chapter we are going to start tomorrow, as well as we will also have the SRS report that is given by the RBI in the financial stability report. So we have completed 2 chapters. That is the first macro financial risk chapter and the second chapter of the financial intermediaries, okay. So as this session is going quite long, so I thought to divide the FSR into 2 parts so that we have enough understanding of the FSR. Recently in December 2022, the Reserve Bank released the 26th issue. You have to tell the GNPA ratio. Okay, I hope you remember this. This is a very important data point that you should remember. The next is the CRAR you have to tell for the urban cooperative banks. Again, this is a confusing data points, but you have to have the clear understanding of this also. Next is regarding the FSR. So you have to tell that which of the following statement is incorrect regarding the FSR. Okay. So thank you very much. Do subscribe to our YouTube channel. In the next session, we are going to have the understanding of the other parts of the FSR. So join our Telegram channel for the PDF of this session also, and do join me in the next session also. Okay. Thank you very much. If you have any query, you can mail us here or you can contact us through this number. Thank you very much, everyone.